morning, everybody. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to go ahead and get the TraderBait app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. It's absolutely free. I will also be doing a summary of this episode with my key takeaways, which will be available for download as a PDF. If you're interested in getting this PDF, click on the link in my Twitter feed or visit placeyourtrades.com/spaces to sign up for it. It will be available and emailed out to anybody that signs up. And I also put a link up in the nest. And on to our guests. So I'll introduce our guest. Where's Mayhem? Our first guest is Tony Greer. Tony began his career in the Treasury Department of Sumitomo Bank and then moved on to join Union Bank of Switzerland as an FX and commodities trader. He returns to New York to join J. Aron and Company. It's a privately held commodities trading arm of Goldman Sachs, where he managed risk for the Goldman Sachs Commodities Index in precious and base metals and in futures and options trading at the New York Merc. He also has worked for top prop firms and on the NYSE trading floor. In August of 2016, Tony created TgMacro, an independent research firm where he combined 25 years in trading experience and 15 years in writing a daily newsletter into one analytical platform. Tony provides fundamental, technical, and behavioral analysis of global markets to a group of institutional clients and a personal subscriber base. Next, we have Joshua Pollard. Joshua specializes in oil due diligence at Altoga Research. Altoga Research is recognized as a leader in oil and gas research in Texas. They have a deep understanding of the industry and has developed a reputation for locating hard-to-find completion documents, well logs, well file maps, and other critical information, as well as generating profitable drilling prospects, providing comprehensive environmental field audits, and simplifying Texas RRC regulatory filing services. He's currently overseeing operations on a restructure in the oil and gas industry. And then we have Markets and Mayhem. Mayhem has been actively trading since 2005, investing since 2006, having become fascinated with finance back during the dot-com bubble, where he executed 2 fateful trades that sparked a powerful passion. He focuses on macro options, technical analysis, intermarket dynamics, and proprietary models using a systemic approach for his trading and investing process. Mayhem has provided institutional consulting on big picture trends and technology since 2013. He co-founded TraderAid and MacroVisor to provide insights to a broader audience of traders and investors. All right, that was a mouthful, and everybody's up here. Yay. Let's get to it. First, I want to thank you all for giving us an hour of your time today. I really appreciate it. I realize that everybody's very busy, and so I'll get right to it. First, I kind of want to get into the weeds with Josh a little bit on the oil market, the fundamentals of this oil market in specific. So the first question I have for you is, we've seen a significant decline in the number of rigs over the last year. I think it was 129 from a year ago of the last Baker Hughes report. In the U.S., and we burned through a significant amount of duck wells over the last 3 years. Yet we have seen production increasing, according to the EIA. So at what point does this or will this catch up to production?
But I think it already has to a degree. But I think once it gets started, it's going to get pretty ugly. I'm not seeing a lot of uptick in activity. It's a weird $85 oil right now. I think a lot of people are sitting back on their production and just waiting for costs to go down. I think right now you're seeing operators really start to lean on their vendors for reductions as well. So um, there's a few outfits ramping up, but in general, it's still kind of just a weird time. I know I've been saying that for a year and a half, but it's been really weird for the last year and a half. So um, it's just one of those deals, and I think we're going to start seeing significant production declines here shortly in the next 30 days, um, 30 to 60 days if we don't start seeing production pick up. But these wells, it can take 30 days to drill a well, another 30, 45 days to bring it online. So it's not a quick process. So um, I think we'll just have to wait and see. But I don't fully trust the data that the government's putting out either. So full disclosure.
Yeah, I kind of agree there. Um, are we still seeing the same kind of problems that we were having, say a year ago, as far as trying to find crews and supply chain issues? Are those still like a prevalent problem, or have we kind of worked through those problems?
Well, it's interesting that the labor is getting better because crews are getting shut down, and it's odd to see good crews shutting down. So that's kind of an indicator to me that operators are just kind of sitting back and watching their production for now. But the labor is getting better, but it's getting better because everything is shutting down. But you still have high tubular costs, high manufacturing, and the like. So it all plays back into it. And then you have mileage and everything else. Propane costs have come down. Guys running propane. Um, LNG out in West Texas to supply trucks is maxed out at capacity right now. That's a big it's a big money saver if you can get into it. A lot of fleets are switching over to LNG, but there's still a bottleneck for LNG too. So it's just an interesting time.
And then on top of that, what are, if we're not really seeing a lot of crews out there, or declining crews, what are like the decline rates looking like? Is this going to be a big headwind for production as well, given the lack of, capex?
Yeah, it definitely slowed down. I was at an auction, a big equipment auction in Wichita Falls, Texas last week, and I was really surprised the big rigs that were used for the deep horizontal wells and stuff like that. Those workover rigs actually went 75 to 100,000 under their value, and then the small rig, a little double single, actually went for 80,000. We were hoping to get it for 30. So that kind of plays into the market right now. You have a lot of workover. I get calls almost every day from workover companies, pull rig companies looking for work right now. Um, I just launched my new company back into oil and gas production. Picked up some wells, and there's damn near fist fights, guys fighting over the work right now. So it's rough for the service companies right now, unless you're in a good contract, long-term contract. I think it's feast or famine right now.
Well, thank you for those insights, and we'll come back to you. I want to move on to Tony. And really, I wanted to ask you something before we get into energy,
Sure.
because today Japan issued its strongest warning in weeks against rapid declines in the yen. And they had its top currency official saying the nation is ready to take any action. It made speculative moves in the market. And we have a BOJ meeting come up. So, what would be the implications to markets should they actually decide to raise rates? I mean, I think the last time they did actually raise rates was back in 2007, when coincidentally U.S. rates were about where they are now.
Yeah. So, Trace, what are you asking?
So basically, my thing is, if the BOJ decides to either raise rates or come in and,
intervene in dollar yen rally or something like that?
intervene, is that, what is this going to do for the rest of the markets?
Yeah, it could change the complexion of the rallying dollar that we've seen. But I got a feeling that if rates keep working their way higher in the U.S. the way that they are and kind of leading the dollar that direction, I got a feeling that the dollar is going to be kind of resilient. And I'm not saying that the BOJ won't be able to stop dollar yen in its tracks, because they will. Especially if they intervene. I mean, that's a clear message that what we saw them last time up at 150 in 2022. So, my idea for being sort of a weak dollar bear was that we're getting toward levels where we've seen central banks intervene, and that's, finally saw the statement out of the BOJ. So it's like not shocking as we get to 150 that we see a comment like that. I just don't know that it's going to take enough wind unless there's an actual intervention. I don't know that it'll take enough wind out of this feedback loop where rates ratchet higher, bonds sell off, and the dollar rallies. So that's kind of my opinion, which isn't a strong one.
Well, thank you. All right.
That's just my read.
No, I wanted your opinion, and I appreciate it.
Sure.
So, now on to kind of energy. So looking at this market right now, obviously, we've had a big rally here. I mean, things are kind of looking a bit overbought. So kind of how are you playing this right now? Because I know that you have been long this market.
Yeah. Chase, we got clients into energy at the end of July. I think it was July 27th. So it's been, like 6 weeks we've been in the trade. If you're following the narrative, you're not shocked at all at the Saudi production cut extension. You're not shocked at all by, Russia's cut extension of their 300,000 barrels. This is kind of the way you would have expected the narrative to play out as soon as the coast was clear from Biden administration SPR sales, right? And that sort of headline front has been totally quiet for weeks. Aramco is planning, but considering selling a $50 billion stake through a secondary. And I would imagine that they're just going to take every opportunity to ratchet oil higher, as high as they can into that sale. And I think that's part of what's going on. I think the other part of what's going on is that, Biden does not have a good relationship with Saudi Arabia. I think they're great having higher gas prices into the next election if they can. And so what's gone on since the headline is that there's been all the strength and the backwardation and tightness has sort of transferred into the oil market, and the gasoline and diesel markets have loosened dramatically. Like, diesel spread went from 12 cents to 6 cents, the front month spread. The gasoline spread went from 14 cents to 7 cents in the front month, and gasoline's been sort of sideways for a couple of weeks. So all the strength is in WTI crude oil, which is fine, but that sort of creates a mixed bag for the stocks. The crack spread's backed all the way off, so the refineries can't rally sharply from last sale. E&P stocks ran into a little bit of resistance. XLE is up at this monstrous top at like 92, 93 that we've seen for a couple of years now. And so it's not shocking that sort of the stocks are kind of spinning their wheels at the highs here. We would need the entire complex to go, student body up and to the right to see, a full-on breakout in XLE, and then, a follow-on rally in oil services and refiners, et cetera. So I am positioned long. I think this is an important time. This is kind of why I bought the commodity oil in addition to buying oil stocks when I got my clients in at the end of July, was because I feel like there's a chance that oil can go flying and the stocks might face some headwinds from the stock market, just by virtue of being U.S. stocks. If rates are going to go higher, that's going to drag big tech down. If big tech is going to go lower, the indices are going to go lower. If the indices are going to go lower, it's hard for me to imagine how, energy is going to explode through that, although I don't think that it will be severely damaged. So that's kind of how I'm looking at things for now. I'm continue to play it from the long side. I'm trying to sort out how how the chips are going to fall with this post-statement rally that where all the strength went into WTI, and trying to find what the next opportunity is in the energy market. But I think that that market is still ripe with opportunity. So that's how I'm looking at energy, Trace.
And then this is kind of like a general market question, but still tied to oil. So, I mean, even though we are coming off the highs over the last couple of days, in general, why do you think the markets have remained so resilient in the face of rising rates? Particularly the energy market, because it seems like everybody's been expecting some huge crash. That was the narrative of why we had a lot of oil weakness at the first half of the year, but the markets have seemed to kind of defy this. So
yeah,
what are your thoughts on this?
Yeah, what we've seen, with this, the S&P is tricky, Trace, especially this year. What we've seen with this sort of last leg of the rally is, in my opinion, the S&P rally to 4,600 that sort of ran into, I would call it the Bank of Japan yield curve control slash Fitch debt downgrade episode that we went through in August, that where markets backed off aggressively. S&P backs off to 4,350, and then has since seen a bounce to about 4,500. So from that angle, what I've seen is that we've seen a giant, rotation within the S&P, where sort of natural resources stocks have come back to life, where some of those sectors like oil and oil services were off 10% on the year. They're now up a couple of percent on the year. And sort of some of the tech stocks that were flying away, that were up, maybe 60, 70% on the year, literally, and 50% on the year, have backed off quite a bit. So, it's just been a big rotation where kind of tech has lost some ground. Energy has come to life. We've seen a strong rally in home builders all year. So this kind of reminds you that there's always a bull market somewhere, although that one seems like it's running into the pressure of higher yields. The damage hasn't been that bad to the S&P. The VIX is sitting down at, in the low teens, and it still feels like money wants to come into the stock market. I think, when you approach, you got to figure out how this NVIDIA story is going to sort itself out now, but that's become, the new religion in technology, where, valuations, blow valuations to hell. These things are going up and there's more money coming in. So that's what I call a religion. And, once we see shake out whether NVIDIA is real or fraud, which seems to be one of the threads that's going around on FinTwit, we'll see if this is going to be a real sustainable portion of the tech rally. So since we ran into that new portion of the tech rally, it's hard for me to fade the stock market with this AI craze going on, and now natural resources coming out of their slumber, as CPI and PPI seem like they leveled off on the downside and want to come back and tick higher again. So I feel like there's a pretty strong inflationary impulse in the market. I feel like that's what's got rates going a little bit higher. I feel like that's what's got some of the natural resources sectors waking up. And if there's going to be a prolonged AI religion in tech stocks, then that will probably carry us, a little bit higher as well through the end of the year. That's how I'm looking at the market.
Excellent. So no crash from your side.
No, I'm not a crashy guy. I wake up bullish, Trace, and for me, the curve is a big deal. The curve is sitting here buried at like minus 70, minus 80 basis points, very tame in that range. If the curve should start to steepen aggressively, my view might change, where, I might expect a more serious pullback in stocks and a serious VIX spike, because that seems to be what the feedback mechanism is that I've noticed, where the curve starts to steepen back towards flat now, right? It was as steep as minus 100 basis points. I'm talking about 2s, 10s in the treasury curve. It's now in a range of sort of minus 80, minus 60 basis points. If that were to steepen towards flat, right, where, the curve, God forbid, went positive, that would be, sort of the catastrophic scenario for the stock market. And I would imagine that the Fed would have to cut rates into that. But that's kind of several steps down the road. Where we are now, I mean, the stock market is kind of in cruise control mode, if you ask me. So I'm not a crash guy at all.
Excellent. Thank you. And Tony, we'll come back to you.
Sure.
We'll have Mayhem. You're up next. So I wanted to talk, let's talk about a little bit about rates in the US, because it looks like BOE and ECB might be done raising for the rest of the year, this year at least. So what are your thoughts on Powell's next move, especially given elevated food prices and obviously higher oil prices, which will likely lead to higher inflation rates, as energy is the main input for, well, everything?
Hey, Tracy. Thanks for having me, and really appreciate the opportunity to discuss this. I think it's a really interesting subject. So I think with the way that the Fed has been approaching this, and really other central banks as well, they've gotten more into the data-driven posture. They're walking the tightrope. They know that with inflation, but also the potential for more economic weakness on the back of much higher rates, that they have to be careful as to how they approach their next step. So I think with regards to the Fed, I don't believe there's going to be a hike in the September meeting. I think it's more likely to be pushed into the last two meetings of the year if we're to see one. But I do believe, and Tony made a lot of great points on this, that we are seeing some signs that inflation may be reaccelerating, and certainly oil pushing that higher with the way it touches just about every part of our lives is a big driver of that. And there's in fact a pretty good correlation between rising oil prices and rising PPI, less of a strong correlation between oil and CPI. But I think the Fed looks at this and they see, especially with what we're also seeing with today's ISM services PMI, a reacceleration in employment, a reacceleration in price, that there is some room for inflation to start to move back higher. We've got the backdrop of last year's beneficial base effects rolling off, that spike in commodity prices during the Russian-Ukraine war. That's behind us year over year, which means also the comparisons are becoming more difficult. So we see services prices, energy and other commodity prices rising. We see rates rising along with them. And I think the Fed's going to have to probably bring the front end of the curve up just a little bit with at least one more rate hike this year. And that conversation is probably something that's going to start to happen and evolve as we get August inflation data this month. And it doesn't look quite as good as people were hoping for.
And, with rising energy inputs, do you see at points in time where, we are headed for kind of a stagflationary environment?
I think that's a really good question, and I believe it depends a lot on what we see with the economic data in the months ahead. So we do see some signs that labor is weakening. We had that JOLTS print last week. We also saw signs from ADP that hiring in travel and leisure, which was one of the biggest areas of hiring in services, has come down meaningfully from 200,000 the prior month to just 30,000 in August. And we are seeing some signs from non-farm payrolls that there's a little bit less appetite for hiring, and particularly with the government revising every single print down this year. So I do think that on the employment side, if we start to see more labor force participation, which was another data point we saw on Friday, and that starts to, absorb some of this excess of available jobs versus people seeking work, then yeah, we have the opportunity for the labor market to actually start to weaken into a slowing economy, while at the same time, there are some signs that parts of the inflationary complex could reaccelerate. And remember, with all of this in mind, we're dealing with all of this without China really coming back online. If they do actually stimulate, as they've suggested they may, in any reasonable size, that could change the thinking around inflation because they're one of the largest commodity consumers in the world. So there is that potential. I don't know that we're there quite yet, but I do think we have to start to discount the idea of a soft landing here at the very least.
And then, can you talk a little bit about the correlation between U.S. Treasuries and, say, the oil market?
Yeah, absolutely. At first, I would say that one of the things that we see in both treasuries and TIPS is that they tend to push higher, particularly in the 5 and 10 years, when oil prices are moving higher. There's a reasonably strong correlation, for example, between the 5-year forward inflation rate, which is the difference between the 5-year Treasury yield and the 5-year TIP yield. That's really strongly correlated with the West Texas Intermediate crude. It's about a 0.83 correlation going back to 2013. So there's a reasonably strong correlation with inflation expectations in oil, but there is also with rates in oil. It's not as strong as it used to be. It weakened a bit after 1985. Some would attribute that to maybe a little bit more energy efficiency over time. But nevertheless, there's a reasonably strong correlation between the 10-year note rate as well as oil. And if you look at a chart, and I can share it in the replies a little bit later, but West Texas Intermediate versus the 10-year note yield, it's got about a 0.77% correlation over the last 20 weeks right now. They are moving as one. And it makes sense. If you think about it, it kind of becomes a bit of a feedback loop. If oil is moving up in price and it's pulling a lot of the other things that rely on oil, industrial, chemical, household, consumer products, food, health, medicine, there's a lot of places that oil touches in our lives, transportation, agriculture. If those prices are pushing up, then inflation expectations rise, which means we have to reprice the premium, particularly on that longer end of the yield curve. And I think we're starting to see a little bit of that as well. So this is a correlation that it ebbs and it flows, but at turning points, it's pretty strong. And I think we are seeing that turning point. And what I mean is we're moving the dial from the recession trade where everyone was looking at going long the longer end of the curve and going short commodities to the other side of the dial, the pendulum swinging the other way, where it's been the trade du jour has been to go long commodities, particularly energy, and fade the long end of the yield curve. So I think we're seeing that rotation dynamic, and that feeds into the same trade. That is to say, the higher oil prices go, the more concerned people get about inflation, the more that rates are going to appreciate with them.
Fantastic. Thank you. And we will come back to you. We'll go back to Josh. I like doing this in a round. And by the way, you guys, if you have a comment to anybody else's comment, please feel free to jump in and talk and make it as much as a round table as you want or don't want. So back to Josh. Let's talk about what do you think, we all know that the Permian is everybody's darling, but, what other basins look like there is opportunity right now?
There's not a lot of opportunity that hadn't already been swiped up. And I think that's the big thing here is that the majority of the good stuff is already taken. So if you want good stuff, you have to either find a new field, a massive field, or you have to start taking out other companies. I think sooner rather than later, offshore and Canada is the only place to go. So to replace reserves.
Do you think we're going to see more consolidation even in this industry? I mean, we've seen, quite a few lately. Well, since 2016, we've seen a lot, but just recently we've seen, quite a few. Do you think that there's still more to be had, more, at least more M&A or more consolidation?
Yeah, absolutely. I don't know if it'll be smart acquisitions, but I think you're going to see more of them because otherwise you can't replace your reserves. And I think you're starting to see a lot of attempts at secondary recovery on shale as well. I've been watching that. Some things look decent, other things not so decent. So I think that will come into play because they're going to, these companies are going to have to start spinning the news to control the narrative that their reserves are shrinking. And it's like 2008 all over again where nobody really has an answer outside of offshore. So I think it'll get, it's going to get pretty interesting over the next 6 to 12 months. I think we're going to see a lot of fakers start to crumble as well with these high interest rates and everything else. So it should be fun.
And that leads me to my next question I was going to ask, have higher interest rates really started affecting operators yet? I mean, we're definitely seeing this in other sectors such as manufacturing, but I don't know how much or if it will really affect these operators.
The larger ones that can make deals, I don't think it hurts them as bad. It still hurts them, but the smaller and medium outfits, the interest rates have been brutal because you've got to factor that in with the labor shortages and all the other costs, the tubular costs, all these things that add into it. So it's been pretty brutal, and it's coming right on the heels of 2020. So it's a lot of guys are still recovering from 2020. So in the conventional side, so it's interesting. I'm actually seeing quite a few restructures and things of that nature. on the smaller scale. I can only assume that some of these bigger companies are having some serious issues as well, just not out in the open yet.
And then what are your thoughts on carbon capture? So far it seemed kind of expensive and generally not really proven technology yet, but we have all these companies pledging millions for it. So do you have any thoughts on that?
I think oil companies need to focus on finding more oil. I think carbon capture is like one of the dumbest things. It's kind of you're trying to placate to the ESG and everything else, and you're forgetting what you're actually supposed to do. I think Shell just quietly abandoned a lot of the projects. It's a distraction. It's a waste of time, and if not for government subsidies, it wouldn't even matter. So all the companies, I think, pounding the desk right now, like Oxy and others, it's because they're running out of reserves and they've got to throw out a new shiny turd to keep investors active.
And then I don't know if you just saw, but Biden just quietly reversed a Trump era rule that allowed for companies to ship nat gas by rail. So that means no more nat gas shipping by rail. So what are the implications for this market, particularly in the Northeast where we don't have a lot of pipelines?
It's just typical legislation that hurts the low and middle classes the most. We see it all the time. It's the oil and gas guys that a lot of them don't necessarily vote Democrat, but none of us are crying when a Democrat comes to office because we know prices are going up. And not to get political, but it's not very common sense policies, and it always hurts the poor people and middle class the most. So it's just par for the course from this administration.
And then and this is kind of a joke question, but kind of not, when is AI coming to the oil patch? Because it seems that we get some of these names, some interest if they just start mentioning AI on our earnings calls.
Well, I know guys that are actually messing with the stuff, and it's very cool what it can do, but it's not a public deal where they're trying to win favor over shareholders. It's just I think a lot of these publicly traded companies, they just try to catch the new cool catchphrase to woo investors, and it's CO2 capture, it's AI, it's all this crap, and at the end of the day, it's you just need to find oil. If you find oil, you're going to be fine. You know, if you're an oil company, find oil.
I like it. All right, and then back to Tony. Similar question kind of that I asked Mayhem. So what are your thoughts on Powell's next move, especially with energy ticking higher here?
Yeah, I'm not great at Fed prognostication, Trace. I kind of just let it all happen and then try to react and come out of it. That's the way that I've learned how to be a successful trader. But I would say, I mean, the Fed posture, I just have a feeling. It feels to me like the markets are set up to kind of hold their hand to the tightening fire. It just feels to me like, we had the way I'm looking at the markets is we had this sleepy CPI number that they couldn't get started if they lit a match at, below 2% for how many, years. We finally got, on the backside of COVID, we finally are seeing, this massive inflation response, which obviously has something to do with them doubling their balance sheet. And, so we saw inflation shoot from 2% to 9% and then pull sort of halfway back to 4%. Looking at this like a trader, you're saying, okay, like this is probably where inflation is going to have to level off. And then you see what happens in the energy markets and you get kind of confidence that that is the way this is going to play out, where on this sort of halfway pullback in CPI data that it's going to start ticking higher. I mean, obviously, will see the next couple of reports be slightly, bigger numbers for CPI, PPI, and I think that that's going to be important for the Fed to have to manage. I think that is going to be their sort of number one task, is figuring out how to keep this inflation in the bottle. And in my opinion, and one of the things that I've been saying, is that inflation is politically structural. We've got this administration, basically canceling drilling and all the executive orders that are against fossil fuels, et cetera, et cetera. And all of that is, permanently inflationary until the executive orders are done away with, and they let these guys drill and explore and get some investment back in that area. So, until the structural inflation is cured, I got a feeling that the Fed is going to be forced to fight it with higher rates, generally speaking, over time, if that's a fair answer to your question.
Yeah, absolutely. And do you think, I mean, heading into an election year, obviously the Biden administration cannot let this economy go into a recession, right? Because that would be terrible. And
even if they have to change the definition of a recession to not mean 2 negative quarters of GDP growth, right? Whatever you got to do.
Exactly. So, I'm thinking that they're going to ramp up fiscal policy to kind of counteract or try and counteract anything that the Fed would do to kind of quash the economy. So
yeah.
I think I think it'll be an interesting year next year.
I agree. I mean, I feel like it's kind of the push and pull now is between the sort of stimulus from the Inflation Reduction Act versus the sort of weakness in the real economy that is sort of keeping things afloat right now. Whether that's may not be correct because I'm not an economist, but that's the kind of vibe that I get from the tape. So we'll see how that pans out. But
and then I wanted to talk about metals for a little bit here. So particularly base and industrial metals. So with all this green push, we have deficits projected for many of these metals. And why, in your opinion, do you think they are lagging so much? Is it all about China? And how are you looking at this market or playing in this market right now?
That is the $64,000 question, Trace, right? Because we're supposed to be having this big push towards battery power everything. We know that battery power everything means, more of those specialty metals like lithium and molybdenum and all that stuff, but it definitely would mean more copper and base metals as well. You pointed out so smartly that inventories are, at sort of historic lows on the LME for base metals. And so you can't figure out how we're going to get this transition done without the price of base metals going much higher, and they don't go up. So I have a feeling one of the factors is definitely they've been fighting this strong dollar, right, for weeks and weeks now, especially dollar yen, going from 130 to 150, and the yuan has also been an aggressive move lower. The yuan has gone, I guess, from from 680 to 730 where we are now. So that's really a strong dollar move that has been, in my opinion, the albatross around the neck of base metals. And for whatever strength they would be gaining from the industrial narrative of the green transition is being taken away by the effects of weak currencies outside the dollar. So we'll see if that persists. But for me, how am I trading it? I'm not, like that's kind of a dead money area for me. I tried being long XME, I think at the beginning of the year, when I thought the scenario was so bullish for them. And I don't think it was much of a trade either side of winning or losing. But since then, I haven't been back in them either way. And my general idea is, every time the dollar turns and heads south, I'm kind of combing the base metals charts to see if there's really something lined up where you can salivate and catch that dollar sell off strong base metal rally. And there really hasn't been anything that compelling. Like the copper chart is just, fake breakout left and right. And so, I'm trying not to get caught up in that buzzsaw over there where I kind of have bullish idea, but who cares about that if the metals aren't going up,
Yeah, absolutely. Absolutely. And then I wanted to talk about what are your thoughts on this kind of recent push against ESG? We had Vanguard leave the Net Zero Alliance. Yeah, the Net Zero Insurance Alliance basically dissipates. BlackRock just puts the CEO of Aramco on its board. Shell backpedaling a bit on green coal. So, I mean, do we see some sanity returning to the
Yeah,
world.
yeah, it feels like, the markets speak to me the loudest, Trace, and what stands out to me and has stood out all year is if you follow the narrative, if you follow the path of the Invesco Solar ETF, the ticker is TAN, right? To me, that sort of um, watching that stock told the story about the sort of Biden administration push towards the green narrative where solar stocks rallied up to 120, by December of the election year 2020 after Biden got elected. And now they've just been sideways to lower, and they're about to break the bottom of the 2022 and 2023 range and head lower. That to me is a sign that that whole narrative is failing, right? And it goes hand in hand with, those changes that you explained that take place at BlackRock and the pushback that they're getting. But I think, it's kind of all over the internet that it's a climate hoax. Like it's becoming like it's kind of going along with this kind of awakening that's taken place, that people are realizing that, you know, the government is putting this trade on, but there is a big climate hoax going on as well, and we don't know how long this push is going to last. And then the ESG stuff, the governance. I mean, the social part fell apart, with the Target and Bud Light stories and stuff like that. So, they have no choice but to sort of ease up on that kind of thing. And and the converse to the solar ETF being off 22% this year is the uranium stocks, finally coming to life. They're up 22% this year. And to me, that's another sort of signal that, the world really wants to naturally gravitate, toward nuclear energy and into that uranium space. So that's kind of how I'm looking at that. I do think that some sanity is going to prevail. I do think that over time, I think all this stuff is going to get reversed, and everybody's going to realize that the government is not going to change the temperature by collecting more money from you. But we'll see how it goes, Trace. That's how I'm playing that idea.
Yeah, absolutely. I mean, we're seeing that, with wind as well right now. They're, like, we have to triple the price, else we can't do this project. You're going to have to pay triple the price, else we can't do this project, it seems like. And all you have to do is look at Germany, right? And see what's happening over there, and kind of, and their refusal to back down on, this green push, and look at what's happening to their manufacturing sector, and everybody leaving there, right?
Exactly. With the optics backdrop of a windmill actually burning on fire and sending black smoke into the atmosphere. I mean, you know what I mean? Like, it just couldn't be coming apart anymore out in the open for that whole narrative, if you ask me. But maybe I'm being overcritical. I don't know.
No, absolutely. I mean, it's, there's Germany's still talking about reopening coal plants, and said, Olaf just said the other day, nuclear's dead. It'll never be here again in Germany.
Yeah.
Okay.
Famous last words.
Right.
Yeah.
All right. Then we're moving back to Mayhem. So let's talk a little bit about the five-year forward inflation expectation rates. Really, they have not been reacting to higher oil prices yet, and yet they were, just a year or two ago. So why do you think this is so? And can we expect this? Can we expect to move higher in the tips?
It's interesting. We actually had a really big outflow from the tips over the last several weeks. Most of August as well saw that outflow, which, is not what you would expect with a backdrop of prices starting to firm up. But it's with also, I think, the notion that just yields on the actual 10-year note are appreciating markedly. Will that spread increase? I think it will. I think it will, as concerns about inflation begin to build back up. And I believe that that's something that's going to be a late third quarter and fourth quarter theme, that we start to see some concerns that maybe we haven't had this immaculate disinflation, that instead inflation, as Tony has said, it's becoming more structural. It's actually becoming more deeply embedded in a number of different areas. So even if the Fed is able to destroy demand, which they likely can with firm enough, tight enough policy, that's only the demand side, and we still have this entrenched inelasticity on the supply side, which I think is a longer-term theme we're going to have to deal with.
And yeah, and I mean, you kind of talked about a little bit about, we kind of talked a little bit about hard landing, soft landing. Can you get into this a little bit more? Because, you know, we have a lot of banks seem to be mixed on this. So I'd like to hear a little bit more of your thoughts on soft landing versus hard landing, if you can do.
Yeah, I'd love to. So one of the things that Tony mentioned was the fiscal impulse, right? And aptly so, because this was one of the areas that helped to drive the economy this year, this positive fiscal impulse in the Inflation Reduction Act, in the CHIPS Act. That drove a lot of GDP. So did some inventory build, but and you know, some variations in the ratio between exports and imports. That's all helped to build GDP. But now we're seeing that positive fiscal impulse run down. And I love how you guys were talking about what happens next year, because I think that's a very interesting question. I think they're going to want to stimulate. The question is, what capacity do they have to stimulate, particularly looking back at all the stimulus we've seen? Will the law of diminishing returns start to have an effect? So I'm looking more for a harder landing than a soft landing, but there's a couple of milestones on that road that I'm looking for to qualify that my view is right, because I might have a gut feeling, or I might be looking at some of the backward looking data, but until I see some trends form that really tell me this, I can't be 100% confident. So what I'm looking for are jobless claims, 300K plus weekly for at least, 1 or 2 months. I'm looking for the services industry to go firmly into contraction. We got the opposite of that today from services PMI, which actually showed prices and employment increasing, right? So some degree of reacceleration in services, which is contributes about 3/4 to U.S. GDP of business contribution. So that's a pretty big deal. But I'd be looking for that to get into contraction, and I'd be looking for the unemployment rate to start to push more meaningfully above 4%, and also increases in these delinquencies and defaults among consumer loans. I think if that starts to play out in the context of also increasing pressure in commercial real estate, these could all be drags. And remember, as we got into this year, another thing that was a big stimulus that was kind of stealthy was actually the debt ceiling debate, because you weren't issuing debt from January all the way through a chunk of June, which is net stimulating. It helps to reduce the amount of liquidity that's being pulled out of bank reserves. So you have that going on. You got the People's Bank of China, Bank of Japan also adding some degree of stimulus to their own banking systems and economies, but there's slippage that always tends to permeate into U.S. markets because, let's face it, we have the most attractive assets on earth. And so all of this helped to pull markets higher, pull the economy higher. Now we're seeing a lot of things go into reverse. The Treasury has not only, started issuing debt again after the debt ceiling was resolved, just in time, miraculously, right? I'm sure it was all a miracle, and none of this was planned in advance to sort of stealthily stimulate the economy. But then on the other side of that, you've got them upscaling issuance for Q3, and we'll probably see an even larger issuance of longer duration in Q4. It makes sense. If you can issue debt at 10 and 30 years cheaper than you can at 2 and 5 years, why wouldn't you go further out on the curve to exploit that lack of appreciation of a risk premium we should have further out? So I think we are going to see some things that kind of go the other direction. The lack of the positive fiscal impulse, the increase in debt issuance, and also likely that the Fed's not really close to done yet, particularly on the QT side. I think they're closer to done on rates, but the balance sheet runoff, they've started to say that that's even going to happen through the next rate cutting cycle, which will change some of the dynamics of what next monetary stimulus policies might look like. So I'm looking more for a harder landing, but I've got to qualify it by seeing the labor market and the services industry weaken materially, because those have been the two pillars that this economy has really clung to. And a lot of that's been driven by this sort of government stimulus as well, which is starting to run off. So maybe we'll start to see those signs.
And then, since you brought up delinquencies, and that chart that's going around, how delinquencies are, ticking up. They're higher. Somebody posted they're higher than they were in 2008, which I think is incorrect. But this chart looks really scary and all. But if you back out of that chart, it's really coming from a very, very low rate. And so should we be more focused on the rate of change? Is that what everybody's worried about? Or is it, a big to do of nothing so far yet?
I think it's not a lot to make of it yet. The consumer is paying a smaller portion, like in terms of what they owe on their debt versus what they have in savings or in income than they were during prior times where they were really stretched when you look at the upper tiers of consumers. However, when you look at the bottom 40% who have less than 1,000 in savings accounts, that's where you're starting to see some stress, particularly in the younger generations. Gen Z, that delinquency rate is as high as 2010. The rest, as you said, that's not as high as the great financial crisis in terms of what we're seeing outside of some of the auto loans. In commercial real estate, however, that's a bit of a different story. We are seeing a lot of stress start to pick up in retail, and particularly office space, where there has been some defaults and delinquencies. I'd be looking for the kind of reality of this is it happens gradually and then all of a sudden. So we are looking at that shift in trend, but we're also looking for that eventuality that maybe we start to see that stress really appreciate. And I think that that comes with higher unemployment. Because if people don't have jobs, they're not able to pay the interest on their debt, then you start to see those delinquencies rise. So I think it's a chain kind of series of events that starts with the jobless claims going over 300K a week and leads to the services industry weakening. And then we start to see those delinquencies rising. And then eventually in the more lagging indicators passing through to the economy.
And do you think, since we're on this, do you think now that they've reinstated student loans, is this going to have a big impact on the markets, as in, people won't have the discretionary spending that they had?
I don't think it's a great thing. I mean, if we look at generational wealth distribution, millennials and Gen Z basically don't have much at all. Millennials have been kind of kept out of the housing market because it hasn't been affordable to them. So they haven't been able to amass the wealth of Gen X or boomers. Obviously, they're younger, but they still don't have that same trajectory. So with that in mind, and with real incomes not really rising much until recently, I think they're still under a lot of stress. So if you have another cost come online for these younger demographics, it may affect their discretionary spending. It may further stress their delinquency rates, like we were talking about with Gen Z being at levels we haven't seen since 2010. So I think those demographics, yes, they are under greater stress. Unfortunately, we have two generations that have been kind of left behind, and adding to that pressure by turning that those interest rate costs on for student debt, which, by the way, you can't discharge in bankruptcy, which we can thank the current president for. When he was in Senate, this was one of the bills that they helped to spearhead so they could securitize and issue student debt and make it look like it was higher quality than it really is. Because if you can't escape it ever, if you're essentially in debt peonage until you pay it off, that's a pretty compelling proposition for folks buying that debt. So, there's other ways to ameliorate this stress as well. Folks that are in it should have the right to declare bankruptcy if they can't afford it, rather than all these sort of stimulus measures and other things.
Absolutely. Absolutely. All right. So we're coming up on the hour. So we'll do the final round, which is the same question for everybody. And we'll start with Josh. And basically it's, tell us, you can talk about something that we haven't talked about that you think is important. Or, what should we be focusing on, particularly as investors in this market over the next year or so?
That's a pretty good one. I think consolidation will continue to happen, but it may, as I said, it may not be good. Depending on what it is, they may be trying to get a splash rather than actual value. I think offshore will continue to go strong. That's probably one of the best places to go right now for operators. But I think over the coming months, you're going to start to see how of rough shape some of these shell, not all the oil companies, but a lot of these shell oil companies are in pretty rough shape. So I wouldn't own a shell company right now. That's just my opinion, but should get interesting. And that's really all I got. Oh, and the Rangers are about to miss the playoffs, so I'm in a wonderful mood right now. So if you watch baseball.
I do not, but thank you very much. That's good stuff to look out for and keep on our radar. So I do appreciate that. And then Tony, same question.
Oh man, I thought the question was going to be Beatles or Stones. I'd be so much better at that. No, Trace, I've been looking at this year as a sort of bar crawl. It's not a year that there's going to be easy trends to jump on that are going to, just run from bell to bell from January to January, and it's going to be a chop festival. A lot of that has to do with the curve being inverted this steeply, which is sort of, historically inverted. And what that essentially means is that there's going to be a snowball coming through your window, whether you like it or not. And that's going to be the meaning, the things that, you'll be rallies that are going along, get damaged by a headline. And there'll all of a sudden be a blow up in this side of the market that, takes the whole market down, or a headline like the Fitch headline or something like that. And so since the whole thing has been a bar crawl, I've been even shorter term oriented trading than I usually am. And so like my recipe from now to the end of the year is really to keep bobbing and weaving. But the sectors that I'm looking at are the sectors that have been performing. I'm kind of watching home builders to see if my idea that higher rates are going to prevail with an inflationary scenario, if the home builders are going to really curl over. That might be a trade for me. This breakout in energy is definitely a trade for me. The breakout in cannabis might turn out to be a trade that I can pursue for a little while. But like my only advice that I've had, and it's worked for people that I've given to that are really in a trading position, is that, this year more than ever, it's been more important to sort of clip your trades, clip your winners, be super disciplined, and move on to the next one. Rather than sort of staying with these sectors that you can sort of ride right into the sunset, that you really don't have to do much trading around. So that's the way of looking at the world. I don't know if that's valuable or not.
Absolutely, 100% it is valuable. Always appreciate your insights.
Thank you.
And,
I would have said stones, by the way, but go ahead.
Okay, I should have asked you that. Damn it.
Nah.
All right. And then Mayhem, your final thoughts. Talk about something that we didn't get a chance to talk about, or what should we as investors be particularly paying attention to over the next year or so?
Yeah, absolutely. So I think that, first of all, it's been a great space. I really appreciate being on. The conversation here has been excellent. I think that looking out over the next year and beyond, what really interests me are the longer term opportunities in the old economy. I think that's a theme that's going to come back. I think that structural inflation, for better or worse, is here to stay. And the Fed, ironically, by destroying demand, by appreciating the cost of capital, is actually going to embed further structural inflation, because you have to pass on that increased cost of capital. But you also have companies that are engaging in the production or exploration of various things, energy, base metals, where that higher cost of capital is going to discourage that same production and exploration, and not just for the immediate future, but potentially for years to come. And I think that all kind of feeds into a theme of, we've been in an era of abundance for, just about 40 plus years. And I think we're coming into an era of relative scarcity of things that we need. And that will present a lot of opportunities for both traders and investors in areas like energy, agriculture, base metals, even areas like water, and areas like labor, where there's a structural lack of participation and just availability in the labor force. There'll be areas like automation to be able to supplement the workforce as well. So I think that we're getting into a situation, and this is a kind of a brain pickler, because it hasn't worked like this for most of our lives, if not all of it, that now the Fed, by engaging in their policy, short term, they can fix inflation by hurting the economy. But long term, what they're doing is actually making the situation worse. And it has a lot to do with policymakers and just sort of twisted investor priorities that have changed things. And of course, ESG has just added to that pressure. So I think that we're going to have a bit of a renaissance in a lot of the industries that we need to sustain life and industry and society as we know it. And it might take some of the priority out of some of the areas that have been perhaps a little bit more bubbly.
Like AI?
Yeah, particularly some of the stocks that have tagged along for the ride that have no right to do so. And I'm thinking of the stock with the symbol AI as one of the poster children of being, I know a lot of people talked about NVIDIA. I don't think there's any fraud there. I've reviewed the company, and, I think there's some things there that are interesting and they raise some curiosity. But if you look at C3 AI really closely, this is a company that is not at all proximal to AI, that advertises itself as such, and is one of the biggest bubble stocks in the entire space that I could personally see losing most of its value that it's gained this year.
Well, we'll all keep an eye on that. And with that, I want to thank you, gentlemen, for taking time out of your day. Again, we all appreciate it. Everybody follow these people on Twitter. They all have good information. And obviously follow Place Your trades, to find out what else we have going on. There's always new stuff going on over there. And then with that, I will see you guys next Wednesday. Have a great rest of your day.
Thanks for having me, Trace. Great discussion. Great job, hon.
Thanks.
Yes. Thank you.
Thank you.
Yeah.
Take care, everyone.